Hi, Kumar here, and we're going to go over the trade management now. As explained in the last video, it is of ample importance that you understand this section and can carry it out correctly, as trade management is all about making sure you are consistently following out your trades correctly, and hence consistently making money from the market. Trade management is simply the way you manage your trade. So in effect, it is the way you use all of the previously covered components. The stops, the targets, the break-evens. Every strategy has its own trade management rules, and we will certainly go over our specific trade management rules in the strategy section later on in the training. Good trade management consists of the following: a clearly defined stop-loss level, a clearly defined target level, a rule to remove your risk from the trade as soon as possible, the break-even rule, and a rule that allows you to lock in profit and maximize the return in your trades. We have already illustrated the first 3 points, so now we will cover point 4. There are 2 common ways in which point 4 above is achieved. Some strategies use one or the other, and some strategies use a combination of them. The 2 common ways are a trailing stop. A trailing stop is simply a protective stop that you keep trailing behind the market as the price keeps going further and further into profit for your trading position. So as a currency moves into more profit for you, you move your protective stop higher if you're in a long position, or lower if you are in a short position, to lock in more profit as price moves in your direction. The trailing stop obviously comes into effect only after the break-even component has taken place. As before this, your protective stop will not be placed at a profitable position. Now you've already seen the trailing stop at work in previous examples we've covered, but we will certainly be going over some more examples with trailing stops. The other method is exiting partial positions. What this means is that you exit a portion of your position at a certain profitable price, just in case price moves back into negative territory for your trade. You still have a smaller position left in the market, and can exit that position at an even more profitable price. But the idea here is that you are trying to capture some sort of profit from the currency as soon as possible by utilizing this method. Let's first illustrate a trailing stop. Let's say we have a trade like this one here, where we have a potential entry where the line goes above this point right here. And if we're triggered into the trade, we will be placing our stop right here. Now as we see here that we did enter into the position and our stop was placed as shown. Now a few price bars later we move our stop to break even. Let's say our rule was to move our stop to break even after we were in about 30 pips profit. So 30 pips profit is around about this level right here. So at the point indicated, when the trade moves 30 pips in profit, we move our stop to break even. So we would move our stop from the original stop loss price to the entry price, when price reaches this point right here. Now we start to exercise our trailing stop. Now trailing stop rules differ from strategy to strategy. It could be that you want to move your stop to 10 pips in the trade's direction as the price moves 20 pips in profit, thus giving you 10 pips for the price to fluctuate and not stop you out. Or it could be that you want to move your stop up to the nearest low after the completion of each bar. There are many ways, and we will discuss our way of trading later on in this training. For illustration purposes, let's say we trail our stop below the low of each bar as each bar completes. This is what would happen. So as price reaches our break-even price, we move our stop to break-even, and as you can see, our entry price is now our break-even stop. And as indicated by the arrow, we are moving our stop below the low of each bar as that bar completes. So as this bar completed, we moved our stop under the low. And then as this bar completed, we moved our stop from this point up to this point. Now as you can see, we get stopped out on the next bar, because remember our stop is right here, and as you can see here, price does come lower than our stop, and we get stopped out. So you can see that we let the market decide when we are going to exit the trade. This allows us to gain as much as possible from the market movement when we get big moves in our direction. The point here is to illustrate that you can move your stop as many times as you like, and if you move your stop closer to the market price to lock in more profit, you are in effect trailing your stop behind market price. Let's take a look at the exact same trade here, and let's say that all the rules are the same except that we want to exit half our position when the first break of a low occurs, and the rest of the position we will remove when the next break of the low occurs. Here's what would happen. So our break-even stop loss is at the exact same place, which is our entry place, because we've actually hit the price where we move our stop to break even. And as you remember, the first break of low occurs here, because this low here is lower than this low here, where our stop was. So at that first break of a low, we sell half our position. Then after this bar completes, we move our stop under this low, and then when this bar completes, we move our stop under this low, so from this low down here up to this low here, and then when this bar completes, we move our stop from the low of the bar before to the low of the current bar that has just completed. Then the same after this bar completes, we move our stop from the low before to the low that has just completed. And now as you see, the dotted line is where our stop is placed, and the red bar here goes lower than our stop, and we get stopped out there. So our remaining half position will get sold there. So what is happening here is, we're not exiting all of our position at the break of a low. We're trying to ride as much of a market move as possible by selling only partial positions. So we're exiting at partial positions. Again, as mentioned throughout this training, the rules that are put into place to work the trade management components are specific to the strategy you are using, and can differ greatly from one to another. There is no set way or set rule for any one component. The rule for taking half our position off in the previous example is purely random, and is just put here to illustrate the point. You could have a strategy that has a rule to take a third of the position off at certain points in the trade. Thus you will be exiting 3 times, a third each time, to exit the full position. You could have any sort of variation, and it really depends on the strategy you are using. So that was a look at trade management. Let's put everything together now and see how well you have learned these concepts. Continue over to the next page so you can start the trade management test. This is Kumar for Trade to Success University, and I'll see you in the next video.